What's going on, people? Happy Monday. Here we are today, and I want to go over a topic that I remember in my days as a manager, I got so many questions on. Currently, on LinkedIn and on other social media platforms, I was asked to make a little video about this. So let's jump right into it, guys. Book to tax differences, also known as add back, also known as temporary versus permanent. These are one of the most important concepts when you're talking about business tax returns because there are certain things that the clients will provide to you on their trial balance, on their profit and loss statements, that for their book purposes, when they're looking at it and they're trying to figure out, what their income and expenses are deductible. But for tax purposes, they're not deductible. So I want to go through that in a very simplified, very high level example. And here it is right here. I kind of put together a little mock-up. So revenue or income is $1 million. We're going to look at the book side of things. Advertising, some expenses that are going to be incurred by this particular client. Advertising, $25,000. Bank fees, $1,000. Rent, utilities, meals, dues, depreciation, amortization. Payroll that they have, fines and penalties, travel, and political donations. The net profit for this particular client is $544,000 for 2023, let's just say. And you're getting this as your paperwork. This is what they send to you before this other column C and D with the adjustments. So what I'm gonna also put this in here right here. This is book income, this is adjustments, and this is taxable income. So let's jump right into it. Now, one of the first things as we're going down, this is one of the most common add backs, also known as unfavorable adjustment, also known as permanent difference. Meals. Why is meals non-deductible? The IRS rule says 50% of meals, these meals we'll assume are 50% category, are not deductible if the client goes out with their associate, their business associate, so on and so forth. 50% of those meals are deductible. So $7,500 is an add back. Why is it an add back? Because it is adding to that net income. It's increasing that net income for tax purposes by $7,500. So it is unfavorable because it is unfavorable to the client's tax situation. If you're increasing net taxable income, that's not favorable to you. Unfavorable. Let's move on down and look at depreciation. Depreciation is another common one. And let me just pause here for a second. Meals, by the way, are permanent book to tax differences because they will never reverse. In the future, as you go into the future, it's not like you're going to get back this 50%. It is permanent. It is permanently disallowed to you that year and will not reverse. So sorry about that. Let's move on. Depreciation, book purposes is $10,000. I want to pause here for a second because for book purposes, and I kind of made this little diagram here real quickly, books typically calculate depreciation on something, on the book basis called straight line depreciation. They'll pick an asset, let's say $100,000. Its useful life will be 10 years. Book depreciation is $10,000 per year. That's simple. Taxes, we got makers, right? Modified, accelerated, cost recovery system. That means you're going to get different percentages every year. But see what is very important to identify here is that on the book side, it's $10,000 a year every year for 10 years. On the tax side, it's these weird percentages, right? Like 10% one year, 25% another year, 35% another year, 16% another year, continuously. But it adds up to 100 in the grand scheme of things over the course of 10 years. So this difference is temporary because it's temporarily out of whack. It's temporarily $10,000 for book purposes, $15,000 for tax purposes, right? $25,000 for tax purposes. It's temporarily a $15,000 adjustment between the books and the tax, right? Because the taxable income is the taxable deduction is $25,000 right here, as it's showing in this little schedule, and I made that up, but work with me here. And the book one is $10,000. As the years move on, the differences kind of go up and down, but at the end of the day, you're getting to the same $100,000 write-off of the full asset by year 10. That is why it's temporary, because it will reverse over time. Now, in this case, as you can see, the tax deduction, 25,000, is larger than the book deduction. Therefore, this is a favorable adjustment because it reduces taxable income. It is also known as a temporary, as I mentioned, adjustment, and is a subtraction, not an add back. Let's move on a little bit further. We'll assume for simplicity purposes everything else does not have any differences. Now we get to fines and penalties. Look, when you pay a fine, right, out of your checking account, that still reduces your checking account and still reduces your profit for book purposes, which is why, again, the client has reflected it here. But for tax purposes, fines and penalties are not allowed as write-offs. You cannot deduct your fines and penalties. So that is an add back, 2,500. And guess what? It's permanent. You will never get to take a fines and penalty deduction in a future year. You'll never get to reverse that over time. It is non-deductible today and will never be deductible. And if you do it again in the future, it will again never reverse. So again, that is an unfavorable deduction or unfavorable adjustment because for tax purposes, you don't get that $2,500 deduction to offset your income. Travel. In this case, I wanted to make a little bit of a distinction here where I carved out $10,000 out of the $35,000 because the client told you, hey man, listen, I went on vacation to the Bahamas with my family and it was $10,000. So just so you know, that was personal. That's not business. That was not me flying to meetings and stuff. I just happened to use my company card. Oh, okay, well, that's permanent. And again, unfavorable. You don't get that deduction. Instead of $35,000 for tax purposes, it's $25,000. And last but not least, political donations are not allowed. You cannot get a charitable deduction for a donation made to a political party. So $10,000 was donated for book purposes. That is an unfavorable deduction, unfavorable adjustment for tax purposes, and it is unfavorable because you get no deduction. In the grand scheme of things, your overall add back, when you add all this up, is $15,000. So your net income for book purposes went from $545,000, which before the adjustments, to $560,000. So it essentially increased by $15,000. So this is the overall summary. Where you're going to find this, I just want to kind of touch on that, is right here, M1. This document, this little schedule right below the balance sheet is super important because that is where all the book to tax differences exist. And you're going to see a column for book deductions not on tax return and tax deductions not on books, or income included on Schedule K, not included in the books, or deductions, expenses recorded on books, not including on Schedule K. It's fairly easy to understand. It's fairly easy to follow. But what I want to drive home to you guys is this is the schedule that line 1 right here on the M1 book income better tie to this book income right here. And then line number 9 right here better tie to the other piece of it, or the taxable income. And that's really what it comes down to. That's what I wanted to kind of drive home to you guys. And I hope this is super helpful to you.